Hi, Luis here. In this video, I want to be talking about some of the qualified retirement plans out there. They generally fall into two categories, defined benefit and defined contribution plans. So let's get started. So the first one is a defined contribution plan. It's called a profit sharing plan. So how it works, as the name implies, the employer shares some of the profit, and it shares some of the profit with all of its employees. Now, it's discretionary employer contributions. So what that means is that for the employer or the business, you don't have to make contributions every year. It's your decision whether or not you want to do it. You don't have to even be profitable to make contributions into this plan. It's only, if it could be retained earnings. So it depends on the employer, the business owners, what they want to do. Now, contributions go into eligible employees' accounts. So each employee has their own individual account. Now, the amount that goes into each employee's account varies depending on a lot of different factors. Sometimes it's income, sometimes it could be age, a lot of different factors. So it's not all the same generally. So that's how it generally works, the profit sharing. Now, what are some of the features and benefits of the profit sharing plan? Well, of course, the contributions, either all or some, could be tax deductible to the business. Of course, we have tax deferred growth. And let me put a little, there we go. Make sure I'm noting out all the things I'm saying. It's also an incentive for the employees. So this plan, because it's profit sharing, the employer could come to the employees and say, hey, if we have profit or if we continue to profit very good, we'll be able to do this type of retirement plan for you guys, because it's going to be shared among all of you. So of course, that could be an incentive for the employees to work harder for you. On this plan as well, I just want to make sure everything's clear. So the money goes in there, generally tax deductible up to a certain limits. It grows tax deferred, so there's no taxes paid. And then at retirement, with distributions, then it's taxable. Whatever the distributions are taken in every year, that will be reported as taxable. So I just want to make that clear. Now, the contributions, they could be up to $58,000 per year per employee. Now, this is based off of a formula, and for an employee to have $58,000 per year, they have to be making quite a bit of money in this plan. So not all employees are going to qualify for this, but just to give you an idea, because generally the business owners, they want to maximize what they can put in. So this is probably more for them, or if they have any highly paid employees, then that they may be close to that as well. All types of business structures can do this plan. So for-profit, non-profit, state and religious organizations could all do this plan, including self-employed individuals. So all across the board, this plan could be done. Also, this plan as well, since it's a retirement plan, it could also help the employees prepare for retirement. Now, one last thing that I forgot to mention is that the employees, they're the ones that manage their account in this plan. So it's not the employer. The employer just makes the contributions. They make that decision. But then after that, it's actually the employees that manage their investments. They choose how to invest the money. So it's up to them, how their returns are long-term in this plan. Now, the costs of these plans, there's generally admin costs, any investment fees. Some of the funds that you use could be very low cost, like index funds, and some could be a little bit higher, like active funds. So it all depends which ones you use. And of course, for the employer, the profit, because the employer is sharing some of the profit, for all their eligible employees. Now, just one other note, eligible employees doesn't mean all employees. The employer generally gets to decide on certain criteria to kind of weed out some of the employees that, maybe employees that don't work that less than a year, if they have high turnover. So it's only those employees that qualify. So it could be a lot less depending on your business that are actually have to participate in this plan, and thus that would affect how much each employee gets and how much profit to put in there. So and then lastly, so the way this plan works is that the employer, so once a year is over, the employer then reviews, usually with their financial advisor or their accountant, how much of the profit or how much they want to contribute to this plan. Because once they have this plan open, they could contribute to this plan up until the business does their tax return. So that's a great thing about this plan, is that the employer, the business, could wait until the end of the year to see how the year went and then decide to partake in this plan or not. So this is the profit sharing plan. Now we're going to talk about another defined contribution plan, the 401k, which is probably the most popular or most recognized retirement plan for businesses. So what is it? So 401k basically is a retirement plan in which the employees are able to save and invest their own money. So generally no employer contributions go into this plan, it's just the employees. The employees are able to put in money on a pre-tax or after-tax basis. Most plans offer both. Traditionally, it was just pre-tax, so so the money goes in there and taxes are deductible on the paycheck. But now, mostly all of them offer the Roth version, so there won't be any deduction, but it's like the taxes are already paid. The employers are able to do at an option, it's called a safe harbor. A safe harbor allows the employer to do a matching up to 4 or 5% per eligible employee. So what that means is that those employees that are even eligible for this plan, because not all employees are eligible, there's criteria there. So for those that are participating, if they're contributing 4 or 5% or more, then the employer just has to match up to one of those numbers. Now, if the employee is putting in 2% of their pay, then the employer just matches up to that 2%. So it's a matching up to these limits. So doesn't mean the employer needs to match the full amount. So it depends on how much the employees contribute. But the safe harbor, what it does is that it allows for less testing in the plan. It kind of makes it automatic. As long as the employer does their matching part, there's no additional testing and reporting of this plan, because that actually is what could increase the total cost of the plan by doing that. So most plans already include the safe harbor in there. The employees manage their own investments, so they have to pick and choose how their money is going to be distributed in that plan, and it's up to them on how they perform in doing that. Generally, long term, it's a good strategy to buy and hold. Use like index funds to kind of diversify, and that way the employees, they're not market timing and doing all this stuff that long term could cost them. But at the end of the day, it's the employee's responsibility to manage those investments, not the employer. So features and benefits of these plans. So there's tax benefits, of course. If it's pre-tax, it's the money that goes in there for the employee is tax deductible. And for the employer, if they're doing the safe harbor, usually all or most of the matching is all tax deductible for the employer. So that money goes in there on the tax deductible basis, and for the employee, once they're retired and they get the money out of there, it's going to be as if it was pre-tax, so it'll be taxable for them. at that time at distribution. So money grows tax deferred. Again, we're able to take advantage of the government benefits of tax deferral growth on the money to get the maximum return on our money. And at distributions, like I mentioned, only the Roth contributions will be tax-free if they're qualified, that is, as well. So if it meets the definition of qualified, it'll be tax-free distributions, which doesn't impact other taxable income, also Social Security, which is a great thing. And any of the pre-tax amount that was in there, and also the employer matching, that is usually taxable. So that'll be taxable for the employee, and of course, only the amount that the employee decides to take out of their account per year at retirement will be taxable, not the full account value. So there, this plan is a good way to motivate the employees to save for their own retirement, because with time they get to see their account grow and grow in value with the power of compound interest. So that's on their side. Employees are able to put up to $19,500 a year. Have the Spanish version there. Up to $19,500 a year, and if those workers are 50 years or more, they can put an additional $6,500 a year. And these are based out of 2021 numbers. So these maximums are adjusted usually annually for inflation. So they're probably going to be different in the years ahead. But as of right now, there's an employee maximum, and then for the catch-up, there's a maximum for that amount as well. Now the match by the employer does not impact these two. So I just want to let you guys know. And the catch-up doesn't also impact this amount as well. So someone that is 50 could get their match, their 5% match, put in the entire $19,500 and an additional $6,500. So that'll be $26,000, probably close to $30,000, maybe even more, that they'll be able to put in for retirement as well. So pretty good. The only business types that can't do these plans are currently state and local governments, but everybody else, for-profit, non-profit businesses, religious organizations, even self-employed individuals. Usually these plans for self-employed are called solo Ks, but because there's only one person. But yeah, all of them are able to do these plans. Now costs. So like I mentioned, for admin costs, if there is no safe harbor, it's going to be more. So usually most plans right now already include the safe harbor because it's just less cost overall, even with the matching for the business to just do the safe harbor and not have to do other reports by the administrator, which is usually a third-party administrator company that takes care of that. So it's less overall cost for the business. Safe harbor, so whatever usually the matching is, that's a cost for the employer, and the investments as well. So the investments have their own fees in there, so they could be very low, like index, which is hardly zero, or medium or a little bit high. Depends on what investments are sponsored by the employer, and that usually the investment advisor helps the employer figure that out, which investments to put in there. Yeah, so this is the 401k. So now we're going to talk about the stock bonus plan, which is also another defined contribution plan. So the stock bonus plan works very similarly to a profit sharing plan, except that the employer contributes mostly company stock. Can also do cash, but it's mostly company stock. Individual employees have their own accounts as well. And so for the features and benefits here, so again, same as profit sharing, so all the same features and benefits as a profit sharing, plus a thing called net unrealized appreciation. So, all right, go there. So net unrealized appreciation means that for the company stock that was contributed to those accounts, once the employee decides to leave the company, or even if they're still there or they just retired from the company for whatever reason, if they want to move the company stock from that account, instead of doing a regular rollover in retirement accounts where it goes from one retirement account to another, and then it's still taxable as ordinary income, the stock here, it needs, now, the employee needs to do, needs to transfer the stock correctly in order to get this. So what's going to happen is that the stock will be moved from this retirement account to like a brokerage account. And so what will happen at that time, the employee or the past employee, the participant, let's just put it that way, will pay taxes on the cost basis of the stock. But the gains, any appreciation of that stock, will not be taxed. So it's as if they bought the stock or have owned the stock in a regular taxable account, you know, ever since they had it in this retirement account. Now that's very advantageous, especially for employees that are in a very high taxable bracket, ordinary tax bracket, because the long-term capital gains of the appreciation, you know, if there's appreciation in the stock, you know, the taxes could be a lot less than, you know, ordinary income taxes. So this is one of a few retirement accounts that allows the participants to take advantage of net unrealized appreciation in the company stock, but it has to be done correctly, or else it won't work. So that's one. Distributions could either be in cash or in stock. Now, because employers are going to be contributing stock, so only corporations can do these plans. So, you know, partnerships, sole proprietors, you know, can do these. And it's the S and C corporations that are able to do that. Usually, this type of plan is best for employers with unstable cash flows, or that they want to keep the cash instead of giving out, instead of giving out cash regularly, like in all the other plans, profit sharing and the matching and other plans. They would rather keep it, but they just are going to have to give away some of the stock. So there is a risk of concentrated stock position, because if all the contributions are stock, then, it depends on how well that stock does in the long term. The employee's value could be, very high, or it could be low, or it could be even, lower than even the cost basis. I don't know. Stuff like that may happen. So that's a risk of concentrated stock position. So the costs, administrative costs, of course, to administer this plan, and stock dilution for the owners. Meaning the owners, because if they give out stock in this plan, they'll be able to, they'll have less ownership in the company. So as long as they're okay doing this, then stock bonus plan may be good for them. And so the last defined contribution plan we're going to talk about today is the employee stock option plan, or what's known as an ESOP. So what is an ESOP? So it's a retirement plan where the employer, and it's only employer contributions, makes, mostly the contributions are in company stock. Cash is optional, but in this plan it's mostly all company stock. And each participant has their own individual account in this plan. So the benefits of this plan is that it's the same as profit sharing, as what we talked about before, so similar to the stock bonus plan, and you also get net unrealized appreciation just like the stock bonus plan, so that you're able to transfer the stock, pay the taxes on the cost basis, and take advantage of the long-term capital gains rate on net unrealized appreciation. Now, for anything above that, after you transfer it over into a brokerage account, then you may be susceptible to short-term or long-term capital gains rate on anything above that from the time you move it over. So talk with your tax professional or financial advisor to know more about that. Now, this plan, the great thing about this plan is that it's probably one of the only plans where the business itself could take a loan from the plan. Not the participant, which you can do sometimes in a 401k, but the actual business could take a loan out of this plan. So quite a bit of money could be taken out. Stock is used as collateral. Only corporations can do these plans, like S and C corps. Employer, usually it's employers that do these plans are employers that want the ability to take out loans to finance their business needs and operations. They want to give either stock to employees, or they want to create a market for their stock for estate planning purposes. That's usually done when the owner maybe wants to sell the business and can't find somebody to sell it to, and so takes out a loan from his plan, and then the buyer pays it back of some sort. So things like that, just to give you an idea. Risks, of course, is stock concentration. If each participant only has one stock, company stock in that account, then of course that there's risk involved with that in case long term it doesn't appreciate. So it could be really good if that stock is a high flyer, but if not, it could also go the other way, or it could just be kind of like break even. I don't know. Alrighty, so costs. Of course, the regular admin costs of this qualified plan that's out there, and also, of course, stock dilution for business owners. So potential decrease in ownership for the owners, whether it's one or all of them. But yeah, when you're able to take out loans, it becomes what's called a leveraged ESOP, or ESOP, however you want to pronounce it. But yeah, this is in a nutshell the employee stock option plan. So talk with your financial advisor to see if it's something that you want to do. All right, so now we're going to talk about the defined benefit plans. A couple of them, not all of them, but most of the ones that the more popular ones. So the first one is probably one that most everyone, or a lot of people are very familiar with, or if they have somebody that's a teacher or works for the government or works for the state, usually those entities have these plans, and they are the traditional defined benefit pension plan. These used to be the more popular ones back in the day in the private sector with businesses, but due to maybe changes in the law or the fees of these plans, they've moved over to the defined contribution plans, which tend to be lower cost, but they're still good, and they still could be done for any type of business structure, for-profit, non-profit, state and local government, as well as religious organizations. So the traditional defined benefit pension plan. So how does it work? So the employer basically guarantees a retirement benefit for the participants. The employer funds a plan with enough funds to guarantee that benefit. Now, it does that using certain types of formula. So there's different criteria for each formula. There's a flat amount benefit, there's a flat percentage amount, there's like a unit benefit formula as well. And I'm very familiar with that one because locally here in California, CalPERS is the biggest pension, well, state pension, and also it's the biggest pension in the United States actually currently. From what participants have told me, they use a unit benefit formula. So these are things like you'll hear them say, oh, well, my benefit, they said that I'm going to get 2 at 55, which means that once they reach age 55, they take the amount of years that they worked, let's say it was 20, and times it by 2. So that's 40. So that's the percentage that they'll get of, I don't know, their average pay, their average, or their highest annual income, 40% of that, something like that. So just to give you an idea. But it's a specific formula that the employer decides to do. Employer manages the entire plan, so they're responsible for everything. So it's a lot of more work for the employer. And as well, these plans have a required minimum contributions on an annual basis. So money has to go in there. So employers need to be ready for that. Now, benefits and features of this plan. So again, the money goes in those accounts tax deferred, So take advantage of the growth. Distributions are usually taxable for the participants once they start receiving money. Any type of business can do this plan, like I mentioned earlier. Contributions can be substantial, possibly even the highest of any of the retirement plans. So as long as it meets the criteria and an actuary down here, as one of the professionals approves it, it could be quite a bit. I mean, if they say, hey, for this employee, Joe Smith, $100,000 needs to be contributed, then boom. I mean, that's already more than the defined contribution plan per individual. Here, there really is no limit as long as the actuary approves it. There's a certain criteria based off of the benefit amount too. So, but that, we're not going to get into there. And I believe the highest potential benefit is like almost 300,000. It's like 250 some, 270 some thousand, but highest benefit. But again, if that's a benefit, then there has to be enough funds in there to pay that benefit per year. So that's why the contributions are pretty high, just to give you an idea. All right, most, or actually all the the contributions are tax deductible to the employer. So this is one of the advantages over some of the other defined contribution plans, because those are limited up to a certain amount. I think it's 25% of covered payroll for defined contribution plans, whereas defined benefit plans, almost all the contributions can be tax deductible, which could be very substantial as well. Benefits are guaranteed by the employer and usually a government entity. So, the participants, they can be rest assured that, hey, they're going to get some benefit, and it's good to have some sort of guarantee on that. Usually the employers that do these plans they have stable cash flows. So they could be big, large, or medium companies, but they're stable companies with good cash flows. They have good retained earnings as well. In case there's some years that they don't do that well, they're able to make a contribution. And if for some reason they can't make a contribution, they don't have the funds, from my colleagues that I work with for these plans, it looks like there may be possibility that they could get like an extension to make the contributions in the future. So talk with your financial advisor, with your accountant, or with your plan organizer to know more about these plans, because there's some wiggle room sometimes. It's not always set in stone, but there's some gray area per se. Let's see here. Okay. The employer also assumes all investment risks, since they're the ones that are managing the entire plan. And the way this plan works is that all the money goes into one account, one giant account. It's not that each individual employee has their own account. Since the employer manages everything, it's all bundled into a huge, one huge account managed by them. These plans tend to benefit older, higher paid employees, because the older they are, if they're going to guarantee them a benefit, that means that they have a shorter time frame for retirement, so more money needs to be put for them. Also, higher paid employees, depending on the formula that they use, because their incomes are higher, their benefit is going to be higher. So of course, more funds are going to be diverted to them. So that's why it tends to benefit them more. Let's see here, costs. So finally, you have quite a bit of administrative costs. These plans are probably some of the most expensive or more costly plans in terms of the dollar amount for the employers. You also have professionals. You got to pay actuaries, accountants, advisors, to manage this entire plan, and of course the contributions that you got to put in. So all that goes into account for all the costs. And any size company can do these plans. It could be small, medium, or large. So, talk with your plan, with your advisor or plan representative to give you like a quote, or do an analysis for you to see if it makes sense to do this based off of the goals for your business, and also usually the goals for the business owner. So yeah, in a nutshell, this is the traditional defined benefit pension plan. Alrighty, so we're at the end of this video, and the last plan we're going to talk about is also a defined benefit plan, which is called the cash balance plan. So how does it work? So cash balance plan, the employer guarantees a benefit, so similar like the traditional defined benefit plan that we just talked about. However, the employer funds each individual account, wink wink, not exactly an individual account, but based off of a guaranteed return. So they plan it this way because this guaranteed return means that if the account earns a certain rate of return every year, then there may not have to be any contributions into those plans if the return exceeds the guaranteed return that the account requires. Now, if it's less, then obviously the employer is going to have to put in more to make up the difference. But as you can see with this plan, since this is the only criteria in terms of funding, or the majority of the funding, it could be a lot less than a defined contribution plan, or defined benefit plan, I'm sorry. The employer manages the plan. There still is a minimum annual funding that is required for it, but it's usually could be a lot less than the traditional defined benefit plan. What are the benefits and features of this plan? There's tax deferral growth still of the money. Usually distributions are taxable. Possibly inadequate benefits because there's a guaranteed return. I mean, it could be like 2 or 3%, a small amount. The benefits for the participants at retirement could be a lot less than a traditional defined benefit plan. So that's also another, disadvantage of this plan. Most business structures can do this: for-profit, non-profit, state, local governments, religious organizations. The contributions usually are tax deductible to the employer since they're all coming from the employer as well. Benefits also guaranteed by the employer and government entity as well. So 2 types of guarantees. Usually stable employers and/or employers that want a lower cost option instead of a traditional defined benefit plan like this plan. Employer again assumes all investment risks. And in these plans, one thing I mentioned, not only for the cash balance, but also the traditional defined contribution plan, there could be an option to have employees also make contributions to the plan if they want to. So I forgot to mention that it could happen in this plan and also in the other defined benefit plan. So employees may contribute to the plan if the employer or the sponsor allows it in those plans, but sometimes they don't, but there is that possibility, so just want to let you guys know. Lastly, the costs. So there's still administrative costs, there's still professional fees costs, but usually less, much lower than traditional defined benefit plans. That's the main advantage of this plan. And this defined benefit plan, as well as with the traditional plan, could be combined with a 401k or a profit sharing or any other contribution plan. So talk with your advisor, your accountant, or your plan design representative to see what you could do if either you, the business owner, or you have highly paid employees that you want to benefit them the most. What's the maximum you can do, given your business capabilities. So thank you for watching this video. If you liked the video, please click the like button and consider subscribing to my channel by clicking the other button below. Remember, the more you know, the better decisions you'll be able to make. Goodbye.